CEO Joel Shulman. Also joining the conversation all morning long this morning is Fox Business's Dagan McDowell and the King's College professor, Fox Business contributor, Brian Brenberg. Great to see everybody this morning. Happy Monday to you. Joel, thank you for joining us. Your thoughts on this week and this next several months for markets as we begin the first quarter earnings reporting season and get more data on inflation.
Well, the financials are coming out this week, Wednesday, Thursday, the big banks like JP Morgan and so forth. What we saw last time is the earnings were a bit off. The revenues were up, but earnings were off because labor costs were rising. They were rising much faster than the revenues were going. So the earnings took a hit. We're probably going to see more of that in this first quarter. We do think, now, what's interesting in the last few weeks, we've seen markets oscillate quite a bit. So we saw tech had a great run between mid-March and the first week of April. It was up in many cases, 20, 30% for some of these ultra-high growth companies. They came back again last week. We saw money moving out of Europe then back into Europe. For example, last week we saw U.S. markets lose about $5-6 billion. We saw international markets gain. So the markets are oscillating. The only thing that seems to be the little pocket, the little ray of sunshine for the markets are these values-based companies like Black Rifle Coffee, like Digital World, and like Rumble. And what happens is they're a little bit controversial sometimes in these cases, but the investor base and the customer base is very loyal. These stocks are performing well. In the case of Black Rifle, up 200% in the last couple of months. Digital World was up is up 350% from their initial point, and Rumble's up about 12% year to date, which in this market is not bad.
Yeah, well, so what do you want to do for the rest of the year? We know the economy is likely slowing down. We're debating whether or not it is going to be a recession. You see oil prices sliding because of the lockdowns in China. And most people expect these lockdowns in China to affect the supply chain. Crude oil now below $100, as you see it, 95.84. Brent is at 140. But what is the case for these supply chain issues? Tesla has not opened. You've got Apple. People are worried. 26 million people under lockdown, Joel. How do you see it impacting markets and the economy?
No question. The supply chain, which started a couple of years ago with COVID, is coming back again. And that's what started our inflation, by the way. The demand pull, where we didn't have goods for a long time, and there's pent-up demand, and they pulled up prices. So we started with demand pull. Then what happened is we went into cost push, because when it starts feeding into the labor costs and energy costs and food costs, it continues to rise and rise and rise. We're going to see a combination again in 2023. What we anticipate, market's going to be very choppy. We originally were interested in, we liked financials coming out of the gate. We're a little concerned, though, with labor costs rising faster than the revenues. We're seeing sectors, for example, you mentioned oil. It had a strong run. Oil, energy and materials had a strong run first quarter. We see that being kind of flat for the second quarter. We see tech, particularly high tech, as you mentioned, with supply chains not going to help it. That's going to be down. We see by the end of the second quarter, we see opportunity for tech to come back strong for the second half of the year.
Yeah, and then there's the inflation situation. Yeah, go ahead, Joel.
Well, I was going to say, we don't anticipate the U.S. having a recession. We do, however, see that in Europe. Europe is going to get clobbered. I mean, Europe has got all sorts of problems. They were already anticipating a slow economic situation in Europe. And then with the issues going on with Ukraine and Russia, of course, their energy costs are going to go out of sight. They're going to have a recession. We are going to be the safe haven. You mentioned, China's going to have problems. They already had problems with Evergrande crisis and real estate. That's going to benefit the U.S. market. So we're not going to have it terrific, but we're going to be better off than Europe and Asia and Latin America.
Well, we got a big portion of the S&P 500 with European revenues, one of the key drivers of their businesses. It's hard for me to believe that you got a recession in Europe and that doesn't impact U.S. corporate profits and the broader U.S. economy. Layer on top of that inflation.
Joel, what do you think the Fed's going to do? How do you think that's going to affect interest rates? And don't you get a little concerned if the Fed is as hawkish as they're now talking? Boy, that looks like a slowing economy in the U.S. as well.
No, Brian, no question. We're going to have a slowing economy. You mentioned the rate increases. Now, the action has all been on the first 2 years. So, for example, the 3-month went from 5 basis points back in December 1st, went from 5 basis points to 70 basis points. It increased by 14 times in the last 5 months. And we're seeing all the action. So it's going from like 20 basis points to 252 basis points, or 2.5%. In the first 2 years, and then it's flat. If you look at it, it's like a straight up and then over. So it's almost vertical for the first 2 years in terms of the yield curve, and then it's flat from 2.5% to 10. It's going to affect mortgage rates probably quite a bit. So to your earlier point, it is going to affect the economy quite a bit in the sense, particularly with mortgages, which are almost doubled in the last year. So it's going to hurt consumers buying housing in the coming months.
Joe, thank you. Joe Shulman weighing in there. We appreciate your time this morning.